In early 2026, the financial press consolidated around a single, highly bearish narrative. Business development companies, or BDCs, were supposedly facing an imminent liquidity crisis. Reporters pointed to genuine macroeconomic friction. They cited AI disruption threatening software valuations, rising non-accrual rates in credit portfolios, and downward pressure on earnings as base rates began to fall. The market reaction was swift. We saw a sharp sell-off across public BDC equity indexes, with share prices dropping as if pricing in immediate devastation. But this reaction presents a mechanical paradox. Broad market indicators are signaling a systemic, liquidity-draining run on a class of funds whose very architecture makes that scenario mathematically impossible. The panic driving this sell-off stems from a basic misinterpretation of fund structures, rather than an actual sector-wide solvency problem. The primary analytical error driving this media cycle is what we call category compression. Market commentary is taking the specific stresses of perpetual, non-traded private credit vehicles and erroneously blending them with publicly traded BDCs, treating two entirely different structures as a single risk profile. To separate the reality from the noise, we need to deconstruct the Q1 2026 data. We will examine the actual numbers on non-accruals, trace the mathematics of leverage multipliers, and review recent asset coverage stress tests. Isolating the actual risk in private credit requires aggressive filtration. We have to run the current headlines through strict structural boundaries, rather than relying on broad market sentiment. Let's start with the mechanics of perpetual non-traded BDCs. In these structures, investors request periodic redemptions. These requests pull capital directly from the fund's net asset value, forcing managers to tap liquidity reserves or sell underlying assets to meet demand. Now look at exchange-listed closed-end BDCs. Investors in listed BDCs trade their shares strictly with each other on the secondary market. They do not redeem their capital directly from the fund itself. Because of this closed-end structure, a severe equity sell-off cannot trigger a run on the fund's underlying capital. Applying the redemption risks of non-traded funds to listed BDCs completely ignores the mechanics of these closed-end liquidity firewalls. This chart tracks the aggregate credit data reported by Raymond James for the first quarter of 2026. You can see average public BDC non-accruals rising from 3.4% at the end of 2025 to 4.1%. Alongside that, the average public BDC recorded a negative 3.3% change in net asset value over the last 12 months. These numbers confirm that there are genuinely weaker credit marks appearing across the sector. However, when we look beneath the average, the assumption of a uniform, sector-wide impairment spiral falls apart. The data reveals severe dispersion. This scatterplot illustrates a clear divide based strictly on underwriter quality. Better-positioned lenders are easily maintaining low non-accrual levels, while a minority of weaker underwriters are driving the top-line increase. In early June, Moody's downgraded specific tickers due to defaults. The ratings agency cited issuer-specific stress rather than the failure of a broad cohort. Aggregate data hides the reality on the ground. Credit deterioration is strictly confined to weak underwriters, leaving the portfolios of the broader sector intact. Another major source of panic was the late January AI software shock tracked by MSCI, which had an outsized impact on BDC equity pricing. MSCI tracked a targeted repricing of software-specific borrower risk, estimating a 6% credit markdown. Watch what happens mathematically to a balance sheet. The debt block is a fixed liability. It cannot compress. Therefore, the entire loss is absorbed by the smaller equity slice. Because BDC equity is a levered claim on the loan book, a minor targeted asset shock forces a disproportionate drop in the equity's value. This mechanical relationship means that stock prices will routinely fall much further than the actual deterioration in the underlying portfolio marks. Widening NAV discounts are largely a function of leverage math amplifying minor asset shocks. They are not definitive proof of deep hidden capital destruction. To address concerns about solvency and software exposure, we can turn to recent stress testing conducted by Fitch. This chart establishes the baseline health of rated BDCs at year-end 2025. The average asset coverage cushion stood at 23.9%, comfortably above the regulatory minimum. Fitch applied an extreme parameter, a 50% write-off of all software assets. Even under this severe weight, the asset coverage cushions compress, but they never break the regulatory threshold. The data proves that the vast majority of Fitch-rated BDCs would comfortably maintain their required asset coverage under severe stress. Systemic solvency fears are contradicted by the baseline arithmetic. The current asset coverage buffers are more than sufficient to absorb massive, localized sector shocks. Looking back at the early 2026 news cycle, it is clear how various institutional reports were collapsed into a single, overwhelming media narrative. We deconstruct this narrative using strict structural filters. First, we separate out redemption waves. Those solely apply to semi-liquid private credit funds, not closed-end BDCs. Second, we isolate the headlines dealing with targeted software sector repricing, neutralizing the equity panic by accounting for the leverage multiplier math. Third, we filter out warnings about specific issuers with rising defaults, recognizing them as an inevitable result of underwriter dispersion rather than a macro trend. When filtered through these structural realities, the unified thesis that private credit is breaking disappears, leaving only narrow, manageable risk vectors. The base-level developments reported in the news cycle, fee income cyclicality, PIK exposure, and specific sector stress, are entirely valid analytical concerns. But while the underlying data points are entirely real, the bearish macro conclusions drawn from them are structurally and mathematically flawed. Financial professionals must aggressively filter broad-brush systemic fear out of their actual investment models. Standard public share price volatility or targeted non-accrual increases should not be treated as leading indicators of systemic failure. True risk assessment in the BDC sector demands a selective issuer-by-issuer analysis based on fundamental underwriter quality, rejecting the lazy narrative of category compression.